All right, folks, ready to get our hands dirty with some financials.
Always up for a good deep dive.
Today, it's Optiemus Infracom Ltd, their Q2 numbers for fiscal year 25. And we've got their official reports right here.
Plus some insightful prep questions to really get us thinking.
Whether you're an investor keeping tabs on Optimus or just curious about the industry, stick with us. There's something here for everyone.
Right off the bat, what grabs me is the growth Optimus is showing.
Yeah. Give us the headline figures. What are we talking about?
Revenue is up a massive 74% year over year.
Seriously.
That brings them to 47,658 lakhs consolidated revenue for Q2.
Wow. Okay. That is impressive.
Mm-hmm.
But wait, I'm looking at their standalone revenue here. It's only 10,155 lakhs.
You spotted it. That difference is huge, right? It tells us their subsidiaries are the real drivers. This isn't just organic growth.
They're on an acquisition spree.
Looks like it.
And profits, keeping pace with that revenue jump.
Absolutely. Profits are up across the board. Profit after tax, their PET, jumped a whopping 154% year on year.
No kidding.
So consolidated PET is at 1,373 lakhs.
For a company their size, that's not to be sniffed at. But to really get why this is happening, I think we need to peek into their statement of cash flows, wouldn't you say?
Totally agree. That's where the strategy comes alive. One line item screaming out is acquisition of investment in subsidiary, including advances.
Okay, I see that. Last year, it was zero.
Now, 16,922 lakhs.
That's some serious cash.
Yeah.
So they're putting their money where their mouth is with these acquisitions we were talking about.
Yeah, it correlates directly with that revenue jump. Acquisitions are fueling this growth engine.
Interesting. Now, another thing I noticed, repayment of loans received. There's a 10,812 lakhs outflow this year.
So they're leveraging debt.
To fuel the expansion, right?
Most likely. It's a common tactic, but we'll want to keep an eye on that.
For sure. On a brighter note, their cash and cash equivalents have increased too, ending at 550 lakhs standalone.
That's good. Gives them some breathing room.
Yeah.
But we got to view it in light of the debt increase.
So it's not all sunshine and roses.
We'll need to monitor that debt situation closely.
Okay, noted. But hey, Optimus isn't just numbers on a spreadsheet, right?
Definitely not.
Their Optimus Unmanned Systems Division, OUS, they've been making waves.
Oh, yeah, the drone stuff?
They were part of that HIM Droneathon in Leh. Pretty cool, huh?
Not just a PR stunt either. The drone market is exploding, and Optimus is positioning themselves.
So they're thinking ahead.
Strategically, for sure.
I read they're bidding on multiple tenders, too, not just talking the talk.
That's what we like to see, concrete action.
All right, so let's recap. Big revenue growth, acquisitions galore, and a dive into the drone world.
But with a little asterisk next to debt levels.
Right, we can't ignore that. But there's more to this story, so let's see where this growth is really coming from, shall we?
Let's do it. Let's break down their revenue streams. Their consolidated statement shows two main segments: trading and distribution, and manufacturing.
So, a bit of both worlds. Making and moving things. Which one's bringing in the big bucks?
Both are contributing to the growth, actually. Q2 FY25, trading and distribution pulled in 10,645 lakhs.
Okay, decent chunk.
But manufacturing, much larger, 34,833 lakhs.
Wow, so manufacturing is the real workhorse here. But both segments are growing, right?
You got it. Both saw substantial year-on-year growth. Trading and distribution up 76%.
Not too shabby.
But manufacturing, they blew it out of the water. 151% jump in revenue.
151%? That's insane. What's fueling that kind of growth in manufacturing?
Remember that big investment in subsidiaries we saw in the cash flow statement? That's likely translating into more production capacity, wider range of products.
So they're not just buying companies for fun.
Nope, it's strategic. Boosting their manufacturing muscle.
Makes sense.
Hey.
But increased production, that usually means increased costs, too.
Right. Can't forget about the expense side of things. Biggest factor there is cost of raw materials consumed.
Got to make stuff Eddie T or something.
Yeah, exactly. It's at 26,597 lakhs for Q2, significantly higher than last year.
Makes sense if they're ramping up production. But those costs can eat into profits if they're not careful.
That's where profitability comes in, and they seem to be managing those rising costs quite well.
Good to hear. Because big revenue doesn't mean much if you're not making any money. What kind of margins are we looking at?
Their consolidated EBITDA margin for Q2 FY25, that's a key profitability metric, stands at 7.21%. actually an improvement from 5.61% same quarter last year.
So they're getting more profitable.
And their PAT margin, that reflects bottom line profitability, also jumped to 2.88% from 1.97% last year.
Okay, so even with costs going up, they're squeezing out more profit from each rupee. That's promising.
Yeah.
Not just growth for growth's sake, but profitable growth.
That's the sweet spot, what matters most to investors. But hey, remember our chat about debt?
Yeah, that was kind of a lingering question mark.
Time to dig into that a bit more. Their consolidated balance sheet shows total borrowings, short-term A&D long-term debt, have increased to 17,870 lakhs as of September 30, 2024.
Okay, that's a chunk of change. Is that a lot for a company like Optimus?
To assess that, we use the debt-to-equity ratio. Tells you how much debt they have for every rupee of equity.
Okay, so what's their ratio, and what is it? So
Based on their consolidated balance sheet, it's about 0.40.
ratios always throw me off a bit. What does 0.40 actually mean in real-world terms?
Simple way to think about it. For every rupee of equity, they have 40 pays of debt. Imagine you invest 100 in Optimus. They've borrowed another 40 to fuel their operations.
Ah, okay, that makes more sense. So is that good, bad, or somewhere in between?
It's not so black and white. No magic number for debt to equity. Depends on the industry, the company's situation. If they have reliable cash flow, they can handle more debt.
How do they compare to others in their field then?
Tough to say without industry benchmarks handy, but 0.40 is generally considered within a reasonable range.
Not setting off alarm bells, but definitely something to keep an eye on, especially with their growth strategy.
Exactly. They might need even more debt to keep that going. It's all about balance. Leverage can be a tool for growth, but they gotta maintain a healthy financial picture too.
Right, too much debt, that's when things can get risky.
Absolutely. Investors need to factor that in. We've seen great revenue, the focus on acquisitions and manufacturing, good profit margins. But one more area I think we should touch on, their corporate social responsibility stuff.
Oh yeah, that's important these days. Investors want to know their money is going to companies that are doing good in the world, not just making a buck.
It's a growing concern, and Optimus seems to be making an effort there. Their website talks about programs for education, healthcare, community development.
Sounds promising. What kind of things are they doing?
Partnering with NGOs for educational resources for underprivileged kids, supporting healthcare initiatives in rural areas, that sort of thing.
That's great to hear. Shows they're thinking beyond just profits, trying to make a positive impact.
It's definitely something investors can feel good about.
Okay, so we've covered a lot in this deep dive.
Yeah.
Optimus's financial performance, how they're growing, that debt question, even their commitment to social responsibility.
We've got a pretty good handle on this company now, wouldn't you say?
Absolutely. But as always, there's more to think about. And that brings us to our final thought-provoking question for you, our listeners. We've seen Optimus is on this acquisition spree. They're into drones now. What's next? What other sectors, companies, could be on their radar?
That's the million-dollar question, right? Trying to predict the future. Optimus isn't afraid to shake things up.
They seem to like those cutting-edge areas, high-growth sectors.
Yeah, and looking at their recent moves, it's logical to think they'll target companies that either strengthen what they already do well.
Or give them a foothold somewhere new, but related.
Exactly.
So if I'm putting on my Optimus strategist hat, I'm looking at companies that fit with their current stuff. Telecom, tech manufacturing, maybe even defense with the whole drone thing.
Right on the money. And don't forget their financial playbook. They're not shy about using debt to make acquisitions.
So they'll be looking for companies in good shape financially.
That can generate solid cash flow, yeah.
This deep dive has been fascinating. Optiemus Infracom, they're definitely a company to watch.
Agreed. Their story is like a microcosm of what's happening in business today. The need for growth, smart acquisitions, embracing new tech, but also that careful dance with debt.
It's a reminder that things are always changing. Whether you're a seasoned investor or just starting out, keep your eyes open for companies like this.
They show the potential, but also the risks that come with being ambitious and innovative.
It all comes back to learning, doesn't it?
Always. The best investors are the ones who keep asking questions, digging deeper.
So keep analyzing those financial statements, stay informed, and happy investing.
Couldn't have said it better myself.
That wraps up our deep dive into Optiemus Infracom. Until next time, folks, keep exploring, keep learning, and keep those insights coming.